The Bulls versus the Bears. Get in the game. www.tackletrading.com.
Matt Justice here for Tackle Trading. As many of you know, for those of you who have been watching the videos and following the blogs and everything, there's many different ways to trade. You got Theta, Delta, Vega trading, and Delta means direction. So when you buy a stock, it's a Delta trade. When you buy a call, it's a Delta trade. Theta means multi-direction or time. It means you're selling options for cash flow. And Vega is all about volatility and bi-directional trading. Well, I love Vega because I put it into the category of trading things we know. We know what happens with earnings. We know what happens with volatility before earnings, and we know what happens with volatility after earnings. Just to recap very quickly, before earnings, volatility rises, volatility rises, volatility rises, volatility rises. After earnings, volatility crushes. And I've already detailed kind of why that's the case in prior videos, so check out the videos at www.tackletrading.com. But at the same time, let's just focus on Chipotle here. Now, Chipotle, CMG, it is what I call a growth stock, a volatile stock, and it does what we call a gap during earnings. Now here, if you go to the trade tab, you'll see that the expected gap in CMG is 50 points. That is the expected gap in CMG. Now, is it going to gap more or less than 50 points is the biggest question. Well, right here you got a gap from about, we'll call it right around 595 up to 650. That was your gap. So it was right around 55 points was your first gap. Your second gap right here, it really kind of gaps up from here. It goes from 445 all the way up to 485. That has a 40-point gap. Then obviously it came right back down. So a 45 gap right there. And then here we got this gap right here. It closes the day before at 490, and it opens all the way up at 450. So we got about another 60-point gap there. Well, I'm looking at this. We got a 45, 55, and 60-point gap. That's looking like a gap right in the 120, 160 range. So we can expect an average of a 53-point gap on CMG this time. Now, that isn't tremendously more than the market maker move. That's fairly accurate with the market maker move. So you can really kind of look at two trades here. You can look at the Iron Condor, which is selling options at a high premium. You'll hold the trade for about a month. The Iron Condor is a great trade. We love the trade. But if CMG gaps outside the 50-point range, it is going to be a difficult trade to manage. You're not going to make money on the actual volatility crush. You'll have to wait till it finishes throughout the entirety of the trade. So you can certainly do an Iron Condor here because it's so close to the market maker move. But at the same time, I'm kind of shying away from that just because CMG, it wouldn't shock me if CMG gaps quite a bit. Well, looking at it here, and also CMG is a higher price point than a lot of the other gaps. The next trade you can look at is the inverted butterfly. Now, the inverted butterfly, it will profit as it gets outside of the wings that we sell. And it is a credit trade because the net result of all the options you're trading is a credit trade. The inverted butterfly, we're going to go to here to CMG. We're going to go 32 days out. And you can do either a call side inverted butterfly or you can do a put side inverted butterfly. They're both very similar in that estimation. A lot of times I'll pick and choose one or the other depending on what my own personal bias towards that individual stock is. What I'm going to look at here is I'm going to look at the put side first. I'm going to go ahead and right click, and I always right click Delta. I'm going to right click sell, but not Condor, excuse me, that was the wrong one. Right click sell butterfly. And as you can see, we're going to buy two contracts of the at the money strike price. So we're going to buy two 650 contracts. I'm then going to half my market maker move. So I'm going to sell 25-point wings. And so I'm going to go out to the 625 put option. And that's an out of the money put option. And then I'm going to go to an in the money put option at 675. So once again, I like to sell about half the range. And we're going to see we get a $3.30 credit. That's on a $2,170 buying power. So let's go and look at a calculator here. Let's see what our ROI would be here. Let's go 330 divided by 2170, and that's going to be a ROI of about 15%, which you could capture the majority. And the reason I like this one a little bit more than I do the Iron Condor, number one, you can capture the ROI a little faster. That's number two. Number two, it gives you a lot of flexibility on managing. If we get a tremendous move to the downside, I can buy back the put options I sold, and I could treat this as a directional put option. If it goes up to the top side, gaps up, I can basically close out the 675 put option for max profit. I can close out the 650 put options that were long, and then I could keep a naked put at 625 or 675 for that matter. So looking at that, it gives me a little bit more flexibility on the trade management. It makes a little bit more on the actual volatility crush, and it's a wonderful trade for earnings. Once again, you're just going to buy an at the money put option or a call option. You're going to sell the wings that are outside the outside and in. So we're going to sell an out of the money put option that is about 1/2 the market maker move out, and we're going to sell an in the money put option that is about 1/2 the market maker move in, and that is the inverted butterfly. And that is how I'm going to approach earnings on Chipotle tonight if I could ever get my order filled. Matt Justice for Tackle Trading. Check us out at the website. Make some posts in the comments section for the video and on the Clubhouse, and we'll see you next time when we're doing an earnings play or an earnings potential trade on Apple.
Get in the game. www.tackletrading.com